Okay, let's unpack this. If you've been tracking the UK economy, you know we expect cycles, slow, often painful decelerations. But what we've witnessed recently was, well, a shock of velocity.
Definitely velocity.
We are talking about the UK unemployment rate jumping a staggering 100 basis points. That's a full percentage point in roughly a year. That's moving from just over 4.0% in late 2024 right up to a stark 5.0% by the July through September 2025 quarter. This wasn't just a move, it was an acceleration that flew past expert forecasts.
It really did. And what's fascinating here is that this 1.0 percentage point surge wasn't the result of a single massive market failure or some external event. Our deep dive into the source material, it reveals that this was a moment of critical confluence.
A confluence, how so?
A dual policy shock, really, where you had two separate government departments effectively working against each other, or at least not quite aligned. And the result was an economic contraction that was far deeper and certainly faster than either had planned individually. You, the listener, need to understand this movement as a quantitative attribution puzzle. We're dissecting precisely which policy levers caused what percentage of that pain.
Exactly. We are moving beyond just reporting that 5.0% headline number. Our mission for this deep dive is to review the quantitative attribution model developed by analysts. This model breaks down the total 1.0 percentage point rise into 4 distinct causal factors.
Right.
We need to explain the mechanics, how each factor contributed to this sharp overshoot, demonstrating how the intentional cooling, which was needed to fight inflation,
It absolutely was needed.
how that was needlessly amplified by a completely separate cost of doing business shock.
It truly is a forensic economic breakdown. We start with the largest slice of the pie, which was the intentional policy designed to slow demand. That's the baseline. And then we build up the smaller but crucial amplifying factors, particularly that collision between fiscal and monetary policy, that pushed the UK labor market not just to its target, but significantly past it. This 1.0 percentage point surge is, well, it's the perfect case study in how interconnected and sometimes profoundly misaligned macro policy instruments can be when they hit the real economy.
Okay, let's start then. Section 1, defining the shock, and importantly, the data integrity.
Crucial first step.
Let's start by confirming the scale and the timeline, because the velocity of this shock is what makes it so concerning. We are looking at a rate that sat comfortably at, 4.1% a year prior to the major increase.
That's right, 4.1%. Pretty stable for a while there.
It then saw a steady climb, hitting 4.8% in the June to August 2025 period. And then the critical jump, it went straight to 5.0% in the July to September quarter.
That final push.
This 100 basis point increase over about 12 months constitutes the sharp upside shock we are examining.
And that 5.0% rate, in absolute terms, it's the highest level the UK has observed since February 2021, I believe.
Right, when the economy was still reeling from the immediate pandemic lockdowns.
Exactly. But the key indicator of a shock isn't just the absolute level, it's the deviation from official expectation. The Bank of England, the BOE, had forecasted pretty consistently in its mid-2025 reports that the unemployment rate would rise, yes, but only to about 4.75% by the end of 2025.
Okay, so the BOE was deliberately engineering a slowdown.
Yeah.
They aimed to raise unemployment by, what does that work out to, 0.65 to 0.75 percentage points?
Precisely. They were targeting 4.75%, so hitting 5.0% a full quarter earlier and exceeding the peak target indicates two things.
Okay.
Either the adjustment process was significantly faster than the bank modeled, or that the aggregate economic shock hitting businesses was simply larger than official forecasters had anticipated.
Right.
That 0.25 percentage point difference, the overshoot beyond 4.75%, that's the critical space we need to fill when we analyze the secondary policy shocks.
But before we dive into the causes, we have to talk about the quality of the data itself. If we rely on a faulty measurement, the whole analysis kind of collapses, right?
Right. Absolutely. It's essential, especially in modern economic analysis, to maintain a degree of, let's say, healthy skepticism when interpreting rapid shifts based on a single measure.
The main measure here is the labor force survey.
The primary source for these unemployment figures is the labor force survey, yes, the LFS. And since the pandemic, the LFS has been characterized by increased volatility and noise. That's something the Office for National Statistics, the ONS, has explicitly highlighted. They even paused some releases to reweight data.
Can you elaborate on why the LFS became so volatile? For the listener, why can't we just trust the number outright?
Well, it fundamentally comes down to sampling. The LFS relies on surveying households, right? And post-pandemic, response rates just plummeted.
Fewer people answering the surveys.
Exactly. Historically, the LFS would interview tens of thousands of households to ensure a statistically robust sample. When those response rates fall, the sample size shrinks and the data becomes much noisier. Small changes in actual employment can look like huge swings in the reported rate.
Making it unreliable for tracking the speed of a change.
Precisely. The velocity. If we were relying solely on the LFS, we might worry that the sudden spike to 5.0% was just a statistical blip, an anomaly caused by poor sampling.
So how do analysts gain confidence that this 5.0% figure is real and reflects an underlying trend? How do we know it's not just noise?
Right. The robust analysis requires cross-referencing this LFS data with a fundamentally different and arguably more solid source. HMRC's pay-as-you-earn data, the Pay Real-Time Information, or RTI.
Tax data.
Exactly. This data set tracks actual payroll submissions made by employers to the tax authority. While the scope is slightly different from the LFS, maybe misses some self-employed, it gives us a very clear, highly reliable monthly indicator of underlying employment trends, and it's far less sensitive to survey volatility.
And the HMRC data is crucial because it confirms that a cooling trend was already firmly in place, and importantly, it predates the sharp spike we saw in the LFS unemployment rate.
Correct. That's the key confirmation. The data shows the number of payrolled employees has been gradually falling since its peak, way back in October 2024.
October 24, okay.
The total fall since that peak is now 165,000 employees. What makes this significant is the granularity. We see specific, noticeable monthly falls of 32,000 recorded in both September and October 2025. This consistent real-time fall in payrolls corroborates the LFS rise, confirming the contraction is genuine.
And here's where the timing becomes the smoking gun. This is what analysts call the chilling effect hook. This gradual decline in actual payrolled employees started immediately following the announcement of the autumn 2024 budget. Why does that specific timeline matter so much when we look at the subsequent jump in unemployment?
It matters because of expectation setting. The autumn 2024 budget was where the massive labor cost increases, specifically the employer national insurance contributions hike. The NIC's hike were announced.
Announced then, but not actually implemented until later.
Exactly. They weren't set to take effect until the start of the new tax year on April 6, 2025. But businesses aren't passive economic actors, they look ahead.
Right, they plan.
The fact that the decline in payrolled employees started immediately in Q4 2024 suggests that forward-looking employers internalized that anticipated fiscal hit. They saw it coming.
And started adjusting straight away.
And initiated preventative measures, hiring freezes, or relying on natural attrition long before the tax officially took effect.
So firms essentially factored in the higher labor costs 6 months in advance. Wow.
Exactly. That corporate internalization of the cost pressure means the fiscal shock was already baked into the deceleration observed in the payroll data even before Q2 2025. They saw a future where their cost base was much higher, and they adjusted hiring models instantly to minimize future financial damage.
So this shows us policy effects don't wait for the effective date.
They wait for the announcement date, at least for forward-looking decisions like hiring. It set the stage for the dramatic and accelerated jump in the headline LFS unemployment rate later in 2025.
Okay, that makes sense. It primes the pump for the later shock. Let's move on then. Section 2. The primary driver, restrictive monetary policy.
Yes.
This is the cyclical baseline, right?
Yes, this is the part that was essentially planned.
Now we move to the part of the shock that was entirely intentional, or at least the direction was. When we talk about engineering economic slack, we are talking about monetary policy. This factor is responsible for the majority of the rise, contributing between 0.55 and 0.65 percentage points. That's 55% to 65% of the total 1.0 percentage point surge. This is the necessary cyclical baseline designed to kill inflation.
This is the Bank of England operating its primary mandate. The Monetary Policy Committee, the MPC, has consistently kept the official interest rate in what they define as restrictive territory.
Meaning high rates.
High rates, yes. This policy is designed to raise the price of money and consequently increase the cost of financing across the entire economy.
Can you spell out the mechanism? How exactly do high interest rates translate into job losses? For someone listening, connect those dots.
Sure. It works primarily by targeting demand. When mortgages are expensive and corporate borrowing costs are high, consumption slows because households have less disposable income, they're servicing debt.
Right, higher mortgage payments.
And business investment dampens because financing new projects, buying new equipment, expanding, it all becomes less profitable or just too expensive.
So less spending overall.
Exactly. This creates a drag on overall economic activity. The ultimate goal, which the BOE is very open about, is to generate aggregate excess supply.
Aggregate excess supply, a very clinical term. Sounds a bit grim.
It simply means that production capacity, how many goods and services the economy can produce, must exceed demand, what consumers and businesses are actually buying.
So firms make stuff, but people aren't buying as much.
Correct. When demand falls below capacity, firms have excess inventory or idle machines, and critically, they realize they have excess labor, people sitting around with not enough work to do.
And that leads to...
The process of reducing that excess capacity is inherently linked to rising unemployment. It's the necessary outcome, the unfortunate side effect, of controlling persistent high inflation that was driven by overheating demand and very tight labor markets post-COVID.
And the BOE wasn't shy about this target either. You mentioned earlier they explicitly projected the unemployment rate to rise to 4.75% by the end of 2025.
Yes, they did.
Since the starting point was around 4.0%, that 4.75% goal represented a 0.75 percentage point rise that was being deliberately engineered.
That 0.75 percentage point increase is the core cyclical demand-driven component. It was the calculated cost, if you like, of getting inflation back down to the 2% target. They needed the labor market to weaken significantly to achieve two things.
Okay, what were they?
First, to signal to firms that demand was genuinely slowing down so they'd stop raising prices so aggressively. And second, to weaken the bargaining power of workers, thereby softening that strong, above-inflation wage growth we were seeing.
Wage growth was a big worry for them.
Huge worry, seen as a key driver of persistent domestic inflation.
We know that GDP growth slowed. The OBR forecast a very muted 1.0% growth for 2025. But there was an initial resistance from firms to cut staff. We heard a lot about labor hoarding. Why did firms resist for so long, and what was the tipping point that forced them into job shedding?
Labor hoarding was a strong theme coming out of the pandemic, definitely. Firms remembered the intense difficulty and expense of recruiting quality staff post-lockdown. Skill shortages were everywhere.
Right, it was hard to find people.
Very hard. So they saw staff retention as a strategic asset. So for a time, even as their profits were squeezed and demand weakened, they chose to retain employees, hoping to ride out what they thought might be a short cyclical downturn, hoping for a quick recovery.
A sort of wait-and-see approach. Hang on to your staff if you can.
Exactly. But the restrictive monetary policy was prolonged, interest rates stayed high. When rates remained high for an extended period, the expectation of a quick recovery evaporated.
Reality bites.
It did. The tightening reached a tipping point, especially around the second quarter of 2025, where the reality of reduced consumer and business spending became inescapable. Firms realized they could no longer justify carrying the excess capacity, the extra staff they had been hoarding. Job shedding became financially necessary to align their workforce size with the reduced market demand.
And that finally fulfilled the bank's objective.
It did. It weakened the labor market enough to start putting downward pressure on wage growth.
So the jump we saw to 5.0% means the bank's cyclical goal has been definitively achieved. More than achieved, maybe. What is the implication of this 5.0% reading for the MPC? Does this sudden success in generating slack change their immediate decision-making?
It's crucial. Absolutely crucial. The current high unemployment figure of 5.0%, coinciding with verifiable softening in average wage growth, which, as we said, was the primary concern, is successfully acting as a disinflationary mechanism. The bulk of the required cooling is now visible in the data.
So mission accomplished on that front.
In a way, yes. This success, albeit painful for those losing jobs, creates the conditions that may strongly influence the MPC to ease its restrictive stance.
You're signaling a potential, perhaps earlier than expected, monetary pivot, rate cuts.
The swiftness of the adjustment means the bank may have done enough, perhaps even more than enough, on the cyclical front. While the IFS still projects peak unemployment might hit 5.1% in 2026, the achievement of 5.0% already suggests that rate cuts are coming much more likely, potentially sooner rather than later.
Because the medicine worked, maybe too well or too quickly.
That's the interpretation many analysts are leaning towards. The bulk of the job losses, roughly 60% of the shock, were a direct, intended, and arguably necessary consequence of the monetary policy tightening required to stabilize prices.
Okay, so that covers the biggest chunk, the intended slowdown. But it doesn't explain the overshoot. Section 3. The amplification shock employer NAC's fiscal policy.
Right, this is where it gets really interesting and, frankly, problematic.
We've established that the Bank of England was targeting 4.75% and successfully generated roughly zero point 0.6 percentage points of that required rise. But we ended up at 5.0%. We need to account for that overshoot, that extra depth and speed. This is where analysts point to the secondary but devastating amplifier, the employer NIC's fiscal shock. Quantitatively, this policy contributed between 0.25 and 0.40 percentage points, a substantial 25% to 40% of the total rise.
Yeah, a huge chunk of the unexpected part of the rise.
This accounts for the majority of the overshoot beyond the 4.75% monetary baseline.
This is where it becomes clear that different arms of government were, well, pulling in opposite directions. The monetary policy shock was a demand-side contraction. It made customers poorer and less willing to borrow.
Okay.
The employer NIC's hike, conversely, was a severe negative supply-side cost shock. It increased the structural cost of employing someone, regardless of how much demand existed in the economy.
That sounds inherently counterproductive. If the Bank of England is trying to manage the economy by forcing firms to shed staff through lower demand, why would the Treasury simultaneously add a massive, unavoidable cost burden that forces them to shed more staff?
That is the absolute central question of this deep dive. It highlights a potential major policy misalignment. The fiscal policy mechanism, effective from April 6, 2025, was brutal because it was two-pronged.
Two hits at once.
Yes. It hit employers hard with a combination of a rate increase and a threshold reduction.
Let's break down those two measures in detail. What exactly did the rate increase entail?
Okay, measure one was the standard rate increase. The main employer NIC's rate rose sharply from 13.8% to 15.0%.
Okay, 1.2 percentage points. Sounds small maybe, but on total payroll.
It's not small at all. That is a significant 1.2 percentage point increase in payroll tax paid by the employer. For every £100 an employer paid in salary above the threshold, they suddenly paid an extra £1.20 in tax. Across a whole workforce, that adds up incredibly quickly.
And measure two, which often gets overlooked but is perhaps the more insidious hit, was the threshold reduction. What happened there?
Right. The secondary threshold, that's the earnings level at which employers start paying this charge, was lowered significantly. It dropped from £9,100 down to just £5,000 per annum.
Wow. From £9,100 down to £5,000.
Yes. This means the employer started paying the NIC's rate on an additional £4,100 of every employee's income, even those on relatively low wages.
So not only did the percentage rate increase dramatically, but the tax started hitting employers on a much lower slice of their employees' income, maximizing the burden, especially on low-wage roles.
Exactly. When you combine those two factors, the financial impact on the employer, the gross cost of employment, is substantial. This widening gap between the gross cost to the employer and the net wage the employee receives is known as the tax wedge.
And the NIC's hike
Violently widened this wedge, made hiring fundamentally more expensive.
Let's look at the specific cost impacts the analysis calculated, because this is the real-world hit. For a median average earner, typically bringing in around £33,000 per year, what was the employer's additional cost burden from this change?
Okay, for that median earner, employers suddenly faced an additional cost of £900 per year. Just like that, an extra £900.
Per employee earning the median wage.
Per employee. That is money that cannot be reinvested, cannot be used for training, cannot go toward productivity improvements. It's just gone in tax.
And crucially, the impact was felt heavily at the bottom end of the wage scale, primarily due to that lowered threshold. For a full-time minimum wage earner at about £22,000 per year, what was the hit there?
The rise in employer NICs was £770 per year. Think about a small business operating on tight margins, retail, hospitality maybe. An extra £707 for every minimum wage employee is substantial.
That could easily be the difference between hiring one extra person or holding off.
Absolutely. Or even letting someone go if things get tighter. And it wasn't just low and median earners. For those earning more, like a £100,000 earner, the cost increase was also dramatic, approximately 14% higher liability, translating to $1,706 annually.
So a pretty significant cost shock across the board then. For the listener, what does this accumulation of £770, £900, or $7,706 per staff member actually mean in the practical decision-making process of a hiring manager? Put us in their shoes.
Okay, well, it fundamentally changes the entire risk-reward calculus for bringing on any new employee. If demand is already shaky because interest rates are high, thanks to the Bank of England,
Right, monetary policy effect.
the projected marginal revenue from a new hire is uncertain. Maybe you'll make more money from them, maybe not. Now, if you add an unavoidable fixed cost of £900 per year per hire, thanks to the Treasury,
School policy effect.
that potential new hire goes from being a marginal, maybe positive decision to an instant negative liability, or at least a much bigger risk. The easiest way for a firm to absorb that cost shock is not to hire in the first place. Or, if demand falls further, which it was doing, to shed existing staff to cover the increased operating costs of the remaining team. It forces a quicker, deeper cut.
Now, to be fair, the government did include a partial offset, specifically targeting small businesses, didn't they?
That's right. There was some mitigation. The employment allowance, which exempts small firms from the first slice of their employer NIC's bill, was increased quite substantially, from £5,000 to £10,500.
Okay.
And eligibility thresholds were removed. This measure was designed to help around 865,000 small employers pay no NICs at all, and perhaps another 250,000 would see their liability decrease. So it was intended to mitigate job losses among the very smallest businesses.
But the analysis shows that the critical burden fell on the employers who drive the majority of jobs, who saw their liabilities skyrocket despite this allowance.
Yeah, the source material is pretty clear on this. While the allowance helped many small firms, 940,000 employers saw their liability increase significantly.
And who makes up that 940,000?
This cohort included all large corporations, the biggest employment drivers in the economy, your major retailers, manufacturers, banks, tech firms, and crucially, it also included public bodies.
Public bodies, like the NHS.
Exactly. The NHS, local councils, police forces, schools, all of whom are ineligible for that employment allowance offset, meaning they had to absorb the 100% full cost increase of the NAC's hike.
Wait. So if the public sector is ineligible for the employment allowance, that means organizations like the NHS, which employs millions of people, suddenly had a huge, unavoidable payroll tax bill dropped on them, right as their budgets were already incredibly stretched.
Immense. It was an immense hit. Local councils, for instance, suddenly had to find millions of pounds per council just to cover the increased employer tax liability for their existing staff teachers, social workers, bin collectors.
And they can't just increase prices or cut dividends like a private company.
Precisely. Their only viable options are to cut services, which is politically painful, or, critically for our analysis, reduce staffing levels through hiring freezes and attrition. This forced cost increase on public bodies ensured the aggregate unemployment rate received a massive, immediate upward push. It was a direct hit to public sector employment capacity.
This brings us back to the core structural explanation for the overshoot, the negative confluence. Let's use a clear, relatable example, perhaps a national restaurant chain or a logistics firm, to illustrate how these two policies collided to force the job cuts beyond the 4.75% target.
Okay, good idea. Let's take a logistics firm, maybe delivering parcels in late 2024. They rely heavily on credit for their vehicle fleet, maybe warehouse leases, expansion plans.
Right.
Policy Shike 1, monetary policy. High interest rates from the Bank of England, say 5% plus LEM, mean their debt servicing costs triple, maybe quadruple. That eats directly into their profit margin, so their marginal revenue falls.
Okay, less profit per delivery.
And consumer demand for goods is also slowing because people have less money due to higher mortgages, etc. So they need fewer drivers anyway. The firm looks at this and decides, okay, we need to reduce hiring by 10%, maybe hold off on expansion. This is the controlled, intended cooling from the Bowie.
They're bracing for a slowdown, maybe letting go of temporary staff, but trying to avoid mass layoffs of permanent drivers.
Exactly. They're adjusting to lower demand. Then, April 6, 2025 arrives. Policy shock 2, fiscal policy. Their new employer NIC's bill lands. Suddenly, the cost of their remaining 1,000 drivers increases by, let's use the median, £900 each.
That's an unplanned £900,000 annual expenditure just appearing on their books.
Bang. Unplanned. Unavoidable. Their marginal cost of labor suddenly spikes upwards.
So when marginal revenue falls due to Bowie policy and marginal cost rises simultaneously due to Treasury policy, the pressure on equilibrium employment becomes immense. The gap just closes.
The margin that allowed them to keep that 10th driver, or even the 9th, just vanishes. They didn't necessarily need to cut permanent staff before April 2025, maybe just reduce hiring and rely on attrition. Post-April, they must cut staff, make actual layoffs, just to maintain their already reduced profit margin against the new higher cost base.
And that explains the acceleration we saw in the unemployment figures around mid-2025.
It does. The fiscal action provided an unnecessary acceleration of the cyclical weakness the BOE was already generating. It contributed directly to the job losses that went beyond the necessary 4.75% cyclical target, structurally explaining a rapid movement to 5.0%.
Indeed.
The two policies were fundamentally working at cross purposes in the labor market at that specific time.
A real pincer movement on employers.
Mhm.
Okay, that clarifies the role of the NIC's hike as the amplifier. Let's move to Section 4, secondary and structural headwinds.
Right, the smaller pieces, but important for the bigger picture.
We've attributed 80% to 90% of the shock to the deliberate dual policy decisions, monetary and fiscal. But the remaining 10% to 20% is made up of fascinating secondary and structural factors that are changing the fundamental nature of the UK labor market and maybe setting up long-term challenges. Let's look first at technological friction, primarily the AI contribution.
Okay, now the quantitative attribution here is small. The analysis suggests 0.05 to 0.10 percentage points, so maybe 5% to 10% of the total 1.0 PP rise. It's really important not to overinflate the AI panic in this specific context.
Right. Generative AI is not the primary driver of the cyclical shock we're discussing.
Definitely not.
But the adoption rate is undeniable. We know AI use globally shot up to, 78% of organizations in 2024, something like that.
Yeah, rapid uptake.
And we know it offers massive productivity gains. Goldman Sachs estimates generative AI could raise labor productivity by about 15% when fully integrated. Doesn't that inevitably mean fewer jobs overall?
Well, it likely does mean a change in the types of jobs and potentially fewer jobs in some areas, yes. But its immediate impact seems to be more subtle and localized, particularly in this time frame. Over the multi-year transition period, most economists expect modest transitory displacement. Goldman Sachs, for instance, estimated unemployment would increase by only about half a percentage point over the entire transition period.
Not in 1 year.
Not in 1 year, no. So AI is certainly not the root cause of the immediate cyclical spike to 5.0%.
So if it's not mass firing, what is the specific mechanism contributing to the current measurable 0.05 to 0.10 percentage point frictional component? How is AI adding to unemployment now?
The mechanism appears to be a targeted recruitment slowdown, not a mass displacement of existing experienced staff. Think of it as organizational augmentation.
Augmentation.
Yeah. If a senior staff member, say an accountant using AI for analysis, a programmer using AI for code generation, or a marketing copywriter using AI for drafts, is now augmented by advanced large language model capabilities, they become more productive.
Right, they can do more work in the same amount of time.
Exactly. And they can then absorb tasks previously assigned to a new junior hire, or maybe even an intern.
Ah, that makes perfect sense. The senior person becomes, say, 15% more productive, which means the firm can hit its output target without needing to fill that entry-level vacancy that just came up.
Precisely. The impact seems concentrated almost entirely in junior and entry-level positions. Some studies have shown that firms whose workforces are highly exposed to LLM capabilities reduced total employment by around 4.5% on average.
Okay.
But that reduction was concentrated in eliminating vacancies for new entrants, not laying off existing staff. This effectively kills, or at least slows down, the traditional skill development pipeline.
It removes the first rung on the career ladder for many.
You could put it that way. AI is acting as a kind of recruitment governor, limiting the ability of the labor market to absorb new job seekers quickly, thereby contributing frictionally, adding a bit of grit to the aggregate unemployment rate. It makes it harder for new people to get in.
That's a crucial distinction. Less about firing, more about not hiring at the entry level. We must now move from that frictional technology-driven element to what might be the deepest structural weakness facing the UK, the persistent constraint of economic inactivity.
This is the critical long-term issue overshadowing everything, really. Now, this factor is attributed a negligible direct numerical rise to the headline unemployment rate in this specific 1 pp jump, maybe 0.000 to 0.05 percentage points. Almost nothing directly.
So it didn't cause the unemployment rate to rise directly.
Not in the way layoffs do, but its role is entirely in amplification of the cyclical shock and, crucially, defining the long-term inflation floor for the economy.
Let's clarify what inactivity means, because it's often confused with unemployment. These are individuals who are neither in employment nor actively seeking work, or they are unavailable to start work soon.
Correct. They're outside the labor force definition. They are not counted as unemployed in the LFS rate, which is why they don't directly drive that LFS unemployment rate up. They're just missing from the workforce.
But the severity of this crisis is staggering. Economic inactivity due to long-term sickness has reached its highest recorded level since records began, hasn't it?
It has. As of September 2024, we had 2.5 million people inactive, specifically because of long-term sickness. That's a huge number. This represents a fundamental erosion of the available workforce, the potential labor supply.
Who are these people demographically? Which parts of the workforce are we losing to long-term sickness?
The demographic shifts are quite concentrated, and they point towards maybe two distinct policy failures or challenges. First, older workers, aged 50 to 64. Many are taking early retirement, often citing ill health, chronic conditions, stress, or long-term disability.
So experienced workers leaving early.
Yes. They may have the financial capacity, perhaps through pensions or savings, to exit the workforce, but often do so prematurely due to health issues. Second, and perhaps more alarmingly for the future, young people aged 16 to 24. They show worryingly high rates of ill health, especially mental health conditions, particularly among those with lower skill levels.
That points to issues in youth mental health services, early intervention, maybe education.
It certainly suggests challenges there, yes. A failure to keep young people healthy and engaged in the workforce or education.
So this outflow of potentially active workers shrinks the available labor pool, the effective labor supply. How does this structural weakness directly amplify the current 5.0% unemployment rate, even if it doesn't directly cause it?
Okay, this shrinking pool has a fundamental effect on the economy's capacity to grow without generating inflation. It dictates the non-accelerating inflation rate of unemployment, or
An ARU, the natural rate of unemployment, basically.
kind of, it's the theoretical floor. The lowest unemployment rate the economy can sustain without wages accelerating uncontrollably and feeding persistent inflation. The BOE had been assuming this equilibrium rate was around 4.5%.
So 4.5% unemployment was considered the sweet spot, where the economy was operating at full capacity without overheating wages.
Precisely, that was the thinking. But because this structural weakness, the 2.5 million inactive due to sickness, has shifted the effective labor supply curve inwards. Basically, the number of healthy people available and willing to work has decreased.
Yeah.
The result is that the BOE now has to engineer a higher headline unemployment rate, the 5.0% we actually observed, to create the same amount of disinflationary slack, the same downward pressure on wages, in the active labor force that might have previously been achieved when unemployment was only 4.5%.
Wow. Okay. So the structural issue dictates the goalpost for the cyclical policy. Because the pool of healthy workers is smaller, you need more people within that smaller pool to be unemployed to stop wages rising too fast.
You've got it. The 5.0% rate we observe is required to create enough competitive pressure and a fear of job loss among the remaining healthy active labor force to finally suppress wage growth. It's the hidden amplifier. The sickness crisis makes the anti-inflation fight require higher unemployment.
It is the hidden amplifier because it means the current jobs crisis is both more acute for those in the active pool and less responsive to short-term demand stimulus, even if the BI cuts rates and demand starts picking up.
The supply side is so severely constrained by illness and inactivity that the economy will hit that inflation ceiling, the NARU, much sooner, at a higher level of unemployment than it otherwise would. We have a fundamental health crisis that is acting as a permanent constraint on economic growth and stability. It's a huge structural headwind.
Right, that sets a really challenging long-term context. Let's move to Section 5, Synthesis, Policy Implications, and the Forward Outlook.
Okay, pulling it all together.
We have meticulously covered the four pieces of the puzzle: the intentional cooling from the BOE, the fiscal accelerator from the NIC's hike, the AI friction at the entry level, and the structural amplifier from inactivity. Now, let's synthesize these drivers and revisit the core breakdown of that 1.0 percentage point surge.
The analysis leads to one single, pretty clear conclusion, I think. The 1.0 percentage point surge is disproportionately attributable to the dual policy actions, monetary and fiscal acting in concert, but with devastating unintended consequences in terms of speed and depth.
So monetary policy first.
Restrictive monetary policy established the required cyclical move. It intended to push the rate from 4.0% towards 4.75% to achieve disinflation. That accounted for roughly 60% of the total rise we saw, the baseline slowdown.
And fiscal policy, the NIC's hike acted as the unnecessary aggressive accelerator and amplifier, pushing the rate rapidly past the monetary target to 5.0%, contributing a significant 25% to 40% of the total. It was the overshoot driver.
Yeah, that's the core finding. This quantitative breakdown allows us to conduct a clear policy misalignment assessment. The NIC's hike was, in this specific economic moment with demand already being squeezed, a sharp, counterproductive increase in the marginal cost of labor. It severely restricted job creation and hiring demand, precisely when monetary policy was already working hard to restrict demand. They were not merely unaligned, they were actively antagonistic in their impact on the labor market.
I think we need to reiterate the critical pain point here. While the employment allowance helped smaller businesses avoid some of the pain, the intensified downside shock was driven disproportionately by the inescapable cost burden placed on large corporations and, crucially, public sector employers.
Yes, the NHS, police forces, local councils, these entities simply had no mechanism to offset the increased tax burden, like raising prices easily, and were forced into immediate cost-cutting measures, including staffing.
This is the operational consequence of the misalignment. The fiscal decision targeted major employers, including non-discretionary public services, with increased operating costs, effectively guaranteeing the aggregate unemployment rate rose sharply and quickly. The NIC's increase functioned as an accelerator of cyclical weakness.
It brought the required pain forward, yes, and intensified the shock needed to control inflation, arguably pushing it beyond what was strictly necessary from a purely cyclical perspective.
Okay, let's pivot now to the forward outlook, because the fact that we hit 5.0% so quickly is now drastically influencing expectations about interest rates and the future path of the economy. What happens next?
Well, the swift achievement of 5.0% slack has generated significant labor market cooling, and it's coinciding with the necessary softening of average wage growth data. That's key.
The bank's getting what it wanted on wages.
Exactly. This achievement, combined with headline inflation also easing, creates the necessary room, the justification for the Monetary Policy Committee to potentially ease its restrictive stance.
So the speed of the adjustment makes a pivot more likely.
It means the bank may now have the mandate it needs for a monetary pivot rate cuts sooner than initially anticipated back when they thought 4.75% would only be reached by year-end.
That suggests the worst of the cyclical contraction may be nearly over. With the current 5.0% rate already approaching the IFS forecast peak unemployment of 5.1% expected sometime in 2026, maybe we're at the peak, or very close.
That's the optimistic case, yes. That the pain was shot, but maybe shorter. However, there is a critical risk warning here that listeners must be aware of, a potential downside.
Okay.
If the full lagged effects of that April 2025 NIC's hike continue to depress business investment and hiring intentions into 2026, and we know businesses internalize that cost shock very early, and these things can linger.
Right, costs stay high.
The peak could be pushed slightly higher than 5.1%. Some analysts worry it could drift towards 5.2% or maybe even 5.3% if those cost pressures continue to bite and weigh on recovery.
Lingering hangover from the fiscal shock.
Potentially, yes. Cost pressures tend to linger and dampen recovery momentum.
And regardless of the short-term cyclical peak, whether it's 5.0% or 5.3%, we must circle back to the structural imperative, the inactivity crisis. Even when demand recovers, the supply side remains broken, or at least significantly weakened.
Absolutely. This is the long game. The structural crisis of 2.5 million inactive people due to sickness means that even when demand recovers, when the economy is ready for the cyclical rebound forecast for late 2026 or 2027, the economy remains structurally prone to inflationary wage growth.
Why? Explain that link again.
Because the supply of available, healthy labor remains constrained. It's smaller than it should be. That means the NARU, the inflation floor unemployment rate, remains stubbornly high, potentially well above the old assumption of 4.5%.
So we fixed the cyclical demand problem with higher unemployment, but the underlying structural supply problem remains, meaning the next cyclical upswing will hit the inflationary ceiling much faster and at a higher unemployment rate.
Precisely. You run out of suitable workers much quicker. This necessitates a sustained policy focus that goes beyond just fiddling with interest rates and tweaking taxes. We need serious long-term investment in workforce health and skills. Targeting the specific barriers preventing older workers from returning or staying in work and addressing the high levels of ill health, especially mental health, among young people. Unless the supply side is fixed, future sustainable unemployment rates might just have to be higher simply to keep inflation stable.
A very sobering thought. Finally, we must look at the transition path for AI displacement. While currently a minor frictional factor, AI's role is expecting to transition, right?
Yes, the expectation is it moves from simply slowing recruitment at the junior end, which is what we see now, to more measurable job displacement in the coming years, maybe 2026 and beyond.
Especially with more advanced AI.
Particularly with the widespread adoption of agentic AI, that's AI capable of planning, acting, and executing complex, multi-step tasks autonomously, not just assisting humans. That could automate entire workflows, not just discrete tasks.
That sounds like a much bigger structural shift.
It is, and it requires proactive government investment now in retraining and upskilling. These programs can no longer focus on just basic digital literacy.
What should they focus on?
They must focus on skills that are complementary to AI capabilities, things AI can't easily do. Interpersonal competencies, complex judgment-based work, ethical decision-making, creative innovation, critical thinking. Those are the human roles least prone to automation by even advanced AI.
So prepare the workforce for collaboration with AI, not competition.
Essentially, yes. The 1.0 percentage point shock has given us the cyclical slack we needed, maybe more than needed. But the next challenge will be managing the structural hole in the workforce from inactivity and preparing the active population for the next wave of technological disruption from AI.
Okay, so what does this all mean for you, the listener, as you track economic news? The key takeaway, it seems, is that macro policy alignment matters immensely. An intentional demand-side cooling from the Bank of England necessary to fight inflation was dangerously and needlessly amplified by an ill-timed supply-side cost shock, the NIC's hike from the Treasury, which made it immediately unprofitable or much harder to retain staff for nearly 1 million employers, especially large ones, and the public sector. The unemployment we see today is less about firms simply failing due to a lack of demand and more about policies colliding to dramatically increase the cost of doing business at exactly the wrong moment.
Well put. And this raises an important, deeply unsettling question that you, the listener, must consider as you track economic policy moving forward. A final provocative thought, if you will. We have successfully generated the slack needed to control inflation, hitting 5.0% unemployment. But given that the structural inactivity crisis seems to be keeping the NARU high, perhaps structurally locked well above 4.5% now, how much higher must we push the headline unemployment rate in future downturns if these structural health issues continue to shrink the healthy available labor pool? Are we now structurally locked into needing a 5% plus unemployment rate, maybe even higher, just to keep inflation stable in the UK unless and until we fix the underlying health and inactivity crisis? Is 5% the new 4.5%?
A deeply unsettling thought indeed about the permanent cost of a constrained labor supply, but one founded firmly in the data we've discussed. Thank you for joining us for this deep dive into policy mechanics and labor market forces. We'll see you next time.